Hey everyone! Welcome back to the channel. If you're looking to build wealth steadily, reduce risk, and create predictable income, today's video is for you. We're diving deep into bonds and fixed income investing, what they are, how they work, the risks, the returns, and how you can use them to strengthen your investment portfolio. By the end of this video, you'll understand the different types of bonds, how interest rates impact bond prices, strategies for investing in fixed income, and how to build a balanced, diversified portfolio using bonds. So grab your notebook, hit that like button, and let's get started. Section 1. What are bonds? Let's start with the basics. A bond is essentially a loan. When you buy a bond, you're lending money to a government, corporation, or organization in exchange for regular interest payments and the promise to get your principal back at a future date, the maturity date. Borrower equals issuer, lender equals investor. Interest equals coupon, loan term equals maturity. For example, if you buy a $1,000 bond with a 5% annual coupon, the issuer pays you $50 a year. It's like the mirror image of taking out a loan, except you're the bank. Bonds are called fixed income investments because they provide predictable, regular payments. That's a key difference from stocks, where returns depend on company profits and market performance. Section 2. Types of bonds. Now, not all bonds are created equal. Let's break down the main types you'll encounter. 1. Government bonds. These are issued by national governments. In the U.S., you have Treasury bonds, T-bonds, Treasury notes, T-notes, and Treasury bills, T-bills. They're considered among the safest investments because they're backed by the government's ability to tax and print money. 2. Municipal bonds, munis. These are issued by state or local governments to fund public projects, like schools or highways. The cool part: interest is often tax-free at the federal and sometimes state level. 3. Corporate bonds. Companies issue these to raise money for expansion or operations. They usually pay higher interest rates than government bonds, but they carry higher risk. The company could default. 4. High-yield or junk bonds. These offer even higher returns, but with a much higher risk of default. Think of them as the Wild West of the bond world. 5. International and emerging market bonds. These can add diversification, but they also bring currency risk and geopolitical factors into play. Section 3A. How bonds work. Interest rates, prices, and yields. Now that we know what bonds are, let's talk about how they actually behave. Here's the key concept: when interest rates rise, bond prices fall. When interest rates fall, bond prices rise. Why? Because new bonds are issued at the new interest rate. So if you're holding a bond paying 3% and new ones are paying 5%, your bond is worth less on the market. This inverse relationship is the most important rule in fixed income investing. Investors track bond performance using yield, which is the return you get based on what you paid for the bond. There are a few yield metrics: coupon rate, fixed annual interest payment, current yield, annual income divided by current price, yield to maturity YTM, total return if held to maturity, accounting for price changes. Bonds can be traded on the secondary market, and their prices fluctuate daily based on interest rate expectations, inflation, and credit risk. Section 4. Risks in fixed income. Even though bonds are considered safer than stocks, they're not risk-free. Here are the major risks to watch for. 1. Interest rate risk. Prices fall when rates rise. 2. Credit risk. The issuer might default. 3. Inflation risk. Inflation can erode your real returns. 4. Liquidity risk. Some bonds are hard to sell quickly. 5. Reinvestment risk. Future interest payments might be reinvested at lower rates. That's why diversification across issuers, maturities, and Type C is key. Section 5. How to invest in bonds. So how do you actually invest in bonds? Option 1. Buy individual bonds. You can buy directly from the government, like through treasurydirect.gov or through a broker. You'll know the exact interest rate, maturity, and who you're lending to. Option 2. Bond funds, mutual funds, or ETFs. These let you own a basket of bonds, offering instant diversification and professional management. Examples include Vanguard Total Bond Market ETF BND, iShares Core US, Aggregate Bond ETF AGG, SPDR Bloomberg High Yield Bond ETF JNK. The trade-off: You don't control individual maturities, and prices fluctuate daily, but they're easier to manage for most investors. Section 6. Building a fixed income strategy. Let's talk strategy. How much should you invest in bonds depends on your goals, time horizon, and risk tolerance. Traditionally, financial advisors use the age rule. Subtract your age from 100 to estimate your stock allocation, and the rest goes to bonds. But in today's world, with longer lifespans and different risk profiles, it's better to tailor it. Conservative, 70% bonds over 30% stocks. Balanced, 50% bonds over 50% stocks. Aggressive, 20% bonds over 80% stocks. You can also use a bond ladder, buying bonds with different maturities so that they mature at regular intervals, reducing interest rate and reinvestment risk. Section 7. Current market trends and final thoughts. As of now, bond yields have become much more attractive after recent rate hikes, making them a compelling part of portfolios again. Fixed income can provide stability, income, and diversification, especially during stock market volatility. The key is understanding the risk-return trade-off, staying diversified, and matching your bond investments to your goals. So whether you're saving for retirement, building a balanced portfolio, or just looking for safer income, bonds deserve a spot in your investment strategy. Thanks for watching. If this video helped you understand bonds better, hit that like button, subscribe for more personal finance and investing content, and let me know in the comments. What's your experience with bond investing? I'll see you in the next video, and until then, invest smart and stay consistent.